Hi. Let's learn about bank stress tests today. A bank stress test is an analysis conducted under hypothetical scenarios to determine whether a bank has enough capital to withstand a negative economic shock, such as a deep recession or a financial market crash. These tests were widely put in place after the 2008 financial crisis to prevent banks from being severely undercapitalized. Banks with $50 billion or more in assets are required to conduct stress tests and report the results on a regular basis. Stress tests focus on key areas such as credit risk, market risk, and liquidity risk to measure a bank's financial status in a crisis. They use computer simulations to create hypothetical scenarios based on criteria from regulatory bodies like the Federal Reserve and the International Monetary Fund. These scenarios could involve specific disasters or include economic indicators like unemployment rates, stock market drops, and home price plunges. Historical scenarios based on real financial events are also used for stress testing. The main goal of a stress test is to see whether a bank has the capital to manage itself during tough times. Banks that undergo stress tests are required to publish their results, which are then released to the public. Companies that do not pass stress tests must cut dividend payouts and share buybacks to preserve or build up their capital reserves. Conditional passes on stress tests require banks to submit a plan of action, and they often lead to reduced dividends and negative impacts on share prices. Critics claim that stress tests are often overly demanding and force banks to retain too much capital, resulting in an underprovision of credit to the private sector. They also argue that stress tests lack transparency and can make banks wary of extending credit during normal fluctuations in business. Additionally, disclosing too much information could lead banks to artificially boost reserves in time for tests. Many banks fail stress tests in the real world, including prestigious institutions like Santander and Deutsche Bank. This demonstrates that even large, well-established banks can stumble when it comes to meeting stress test requirements. Here are 4 key takeaways. 1. A bank stress test is an analysis to determine whether a bank has enough capital to withstand an economic or financial crisis. 2. Bank stress tests were widely put in place after the 2008 financial crisis. 3. Federal and international financial authorities require all banks of a specific size to conduct stress tests and report the results on a regular basis. 4. Banks that fail their stress tests must take steps to preserve or build up their capital reserves. Hope this would help. Thanks for watching.